everyone. Welcome to Charts and Perspective, where we use charts to dive into the world of economics and financial markets. I'm Jennifer Nash, an economic and market research analyst for TMX Verify. In this video, we're going to examine the federal funds rate and review the Fed's latest meeting. The federal funds rate is the overnight interest rate banks charge each other for borrowing. Set by the Federal Reserve's FOMC, it's a core tool for monetary policy and has a major influence on economic activity. When this rate shifts, it directly affects borrowing costs for consumers and businesses and ripples through financial markets, impacting everything from bond yields to stock performance. The FOMC concluded its last meeting of the year with a widely anticipated 25 basis point cut to the federal funds rate, bringing it to a range of 3.50 to 3.75%. This is the third consecutive rate cut and puts the central bank's range at its lowest level since November 2022. Policymakers once again had limited data for this decision, as the lingering effects of the government shutdown continue to delay or omit crucial economic reports. Nevertheless, the policy move itself was highly anticipated, with a greater than 90% likelihood heading into the meeting. Consequently, many eyes and ears were tuned into the press conference, which offered several important takeaways beyond the decision itself. The Fed noted their strong commitment to their dual mandate of maximum employment and low inflation with a target rate of 2%, which we have attempted to visualize in this chart. Note that all figures, besides the Fed funds rate, are only through September as a result of the shutdown's data delay. With regards to the labor market, the Fed stated that job gains have slowed this year, and the unemployment rate has edged up through September, adding that recent indicators are consistent with these developments, and therefore they now judge that the downside risks to employment have risen in recent months. With regards to inflation, the Fed continued to describe it as somewhat elevated, and again commented that it has moved up since earlier in the year. Additionally, the Fed reiterated that uncertainty about the economic outlook remains elevated. It's easy to see in this chart how the Fed's comments are ringing true. The unemployment rate remains low, but has been trending higher this year, with the latest unemployment rate at its highest level since October 2021. And inflation has proven sticky over the past few years, never quite reaching that 2% target level, with the most recent figures for both CPI and PCE heating up to their highest levels in nearly a year and a half. So what's next? The committee stated they're prepared to adjust their stance as appropriate if risks emerge that would impede their goals, and they'll continue to take into account a wide range of information, such as reading on labor market conditions, inflation pressures and expectations, and financial and international developments. Given this guidance, how is the market interpreting the Fed's next moves? The CME FedWatch tool estimates the probability of future interest rate moves. It's updated in real time in response to economic data releases, Fed statements, and market movements. This chart here shows the tool shortly after the Fed's latest meeting. At the time, markets were expecting 2 more 25 basis point cuts in 2026. Note that since this tool is updated in real time, expectations are constantly shifting, and will likely be different, even if just slightly, by the time this video is released. Now, earlier in the video, I talked about the key takeaways from the Fed's meeting. But what I didn't discuss, and is perhaps one of the biggest takeaways, was the Fed's dot plot. Once a quarter, the Fed releases their dot plot to reveal each FOMC member's individual projection for the target level of the Fed funds rate at the end of the current year, at the end of the next 2 years, and in the longer run. In the latest dot plot, the FOMC participants' expectation is for a gradual but steady decline over the next few years, eventually falling to around 3% in the long run. However, this planned easing is accompanied by mixed views within the committee, indicated by the widening spread of dots in future years, especially concerning the pace and total number of rate cuts needed. But just like the CME FedWatch tool, these projections are not set in stone and will likely shift over time. The Fed's next meeting is scheduled for January 27th and 28th, with the next dot plot to be released at the following meeting on March 17th and 18th. That's all for our discussion. Thank you for tuning in. For more economic and market insights, you can find my content on the Advisor Perspectives website under the AP Chart section.